Good morning. My name is Brendan Manning. I'm the Vice President of Education and Environment here with the AGC. I want to welcome everybody here this morning. I see attendees are starting to pile in quickly, so we'll give it another minute, but I'll do a quick introduction. Our program today is Construction Trends and Outlook, Recession or Resurgence. Our speaker today is Ken Simons, and Ken is our Chief Economist with the AGC of America. I'm sure a number of you have heard from Ken before in the past. We try to do this annually, at least with Ken, and I'm sure you've heard some other programs directly through AGC of America. Fast rising interest rates and high inflation have driven up the U.S. economy into recession, or at least the cusp of one. But infrastructure, manufacturing, and several other construction categories are on the upswing. Will the growth of the construction segment persist, even if the overall economy stagnates or slumps? I'll let Ken get into this. Ken, again, has been the Chief Economist with AGC of America since 2001. He provides insight into the economy and what it implies for construction and related industries through frequent media interviews, presentations, and the Data Digest, his weekly one-page e-newsletter that goes to more than 20,000 subscribers. Ken has more than 40 years of experience analyzing, advocating, and communicating about economic and tax issues. He's a fellow and past president of the National Association for Business Economics, and he's co-director of the Tax Economics Forum, a professional meeting group he co-founded in 1982. Ken has a BA in economics from the University of Chicago and an MA in economics from Northwestern University. So with that, I will turn it over to Ken.
Great. Well, thank you, Brendan. Happy New Year, everyone. I hope I get to see some of you in Las Vegas at the AGC of America convention, March 13th, 16th, or else in your home state at some point during the year. I want to start today as soon as I can make sure that I have the right slides up here. I want to start with the employment situation, first nationally, but then we do have some detail on what's going on in New York State. So let me get this moving. The Bureau of Labor Statistics reports on the first Friday of each month, as they did last.
Ken, I just wanted to jump in. Your display settings are back to that notes.
Oh, right.
Page.
Okay. Yep. Thank you.
Okay.
And the employment nationally for construction shows a very different pattern between residential and non-residential construction.
For some reason, it's still showing the same display. I'm not sure.
All right, let me get
all right, one more time.
Okay, let's get this started again.
There we go.
Okay, sorry. Yeah, the Bureau of Labor Statistics reports on 5 categories of construction, and I've combined these into 2. The residential construction comprises home builders and general contractors who are doing multifamily mainly, and then also specialty trade contractors, whether they're working on new homes or additions and renovations to existing homes. And you can see that blue line is well above where it was in February 2020. In fact, residential construction has increased its employment more than almost any other sector in percentage terms. And to my surprise, it continued growing right through the December report that we got last Friday, even though every other indicator for single-family homes shows a steep downturn. So I do think residential construction is very close to peak and will be tailing off over the course of the year. That could be good news for some non-residential contractors because, as you see on the red line, non-residential construction, while it's been growing for the past year, it's still below where it was in February 2020. A major reason for that is that contractors are having trouble finding enough workers. And I think this is certainly true in New York as it is elsewhere. Nationally, job openings at the end of November were at a record level compared to November in the previous 21-year history of this series, 344,000 openings. And that exceeded by almost 50% the number of people who were hired in November of 2022. This situation has been occurring throughout 2022, where job openings are setting a record compared to previous months of that year, previous years for that month, and have in most months exceeded the number of people hired for the first time. So the implication is the industry actually wanted to bring on twice as many people as it was able to find. I think a reason that the industry has fallen behind in filling positions is that what I call the wage premium for working in construction has eroded. The bar on the graph on the left shows the average premium, that is average hourly earnings for so-called production and non-supervisory workers in construction compared to the overall private sector, was pretty consistent. It was between 20 and 25% for 2 decades. It averaged 21.5%. As soon as the pandemic hit, though, industries that historically had paid minimum wage to starting workers, or even less in the case of tipped restaurant employees, they were boosting their wages to $16 or even $18 an hour for jobs like fast food, food delivery, and trucking, local trucking and warehousing. So while construction pay did not go down, it didn't rise as much as it did across the private sector. And that premium to get people to come out and work at all kinds of weather and start earlier than I like to get up in the morning, that premium eroded briefly to below 15%. It's come back somewhat, but it's still 18%, not nearly as big an attraction as back before the pandemic. On top of that, people's preferences for work situation have changed. Certainly, I like the chance to work from home part of the time and to have flexible hours, to know that I can go get my car inspected as I did yesterday morning, don't have to be at the office at a fixed time. And if need be, I can get home relatively quickly and on short notice. None of those things is possible for an on-site construction job. And so the combination of not getting that extra 20% or more to work in construction and having more rigid working conditions in uncomfortable or remote situations is making it very hard to attract and retain workers compared to other industries that now have greater flexibility and are closer to matching the industry in pay. So I think the implication here is that contractors are going to have to raise pay even more. Now, that in the last year, average hourly earnings for these production workers, that's the craft workers and non-supervisory office workers, that pay has been rising faster than it has across the board. It was up 6.1% from December of 2021 to last month in construction, up 5% in the total private sector. But as you can see by comparing these two graphs, there's still quite a ways to go to close that gap. Well, here's the situation in New York. Sadly, you had a much steeper loss of jobs at the beginning of the pandemic. I don't have to tell you how strict the shutdown orders were. And you've never recovered to the point that the U.S. has. Total U.S. construction employment is now slightly above where it was in February of 2020. But for New York State, you're still lagging by tens of thousands of jobs. The picture varies somewhat from metro area to metro area. In New York City, employment has been flat. We don't have December numbers yet for a state or a metro. That'll be coming out in 2 weeks. But you can see that in the last year, New York City construction employment was flat. It was up slightly in Long Island, up very sharply north of the city, and varying figures for the upstate metro areas. But in general, still lagging where you were in, we don't have seasonally adjusted numbers for the metros. So here I'm comparing to the last November before the pandemic and not doing so well. Well, let me move on to what's happening to costs. The red line here shows the producer price index for inputs to new non-residential construction. That's a weighted average of all the materials used in non-residential construction and selected services such as trucking and design services. The blue line shows the consumer price index, the usual layman's notion of inflation. And the point of this graph is that the increase in costs for construction, these are year-over-year changes, the increase in costs for construction has been much greater over the past 2.5 years than inflation at the consumer level, even though that was making headlines every month. Now, at the right side of the graph, you can see that the situation has improved. The CPI increase has tapered off from 9.1 to 7.1%. The Fed, of course, wants to get it down by a slightly different measure, get it down to about 2%. The construction input price index has gone from well over 20% last spring and summer down to 10.1% from November of 2021 to November of 2022. So it's still rising at double-digit rates. And I think it's important for owners to understand when they hear that inflation is coming down, the answer from a contractor is yes, but. And in fact, it's not coming down for everything. This graph picks out our table picks out 8 of the thousands of producer price indexes, several hundred that go into construction. And you can see that in that first column, the 1-month change, there has been some improvement. Diesel fuel prices came down substantially at the producer level from October to November. There was slight decline in the cost of asphalt paving mixtures and block, but concrete products have been rising pretty substantially. And when you look at a year-over-year basis, all of these had significant double-digit increases, as did subcontractor prices. So contractors are still being hit with a variety of price increases. There are also a lot of things that are on allocation or very extended delivery times. Overall, the supply chain has gotten better, particularly in terms of getting ships into berths on the West Coast ports and then moving those containers inland. Some of that ship traffic has moved to the East Coast ports, and that's led to some delays there. But overall, shipping times and trucking times, rail movements have gotten better. But there are particular items that are experiencing even longer delays than before. I'm thinking of transformers and switchgear. The delays have stretched out well over a year for some switchgear. Transformers, I'm hearing as long as 2 years. And then for concrete products, a majority of states are in very short supply, and contractors are being put on allocation. So if you need to add another mile to a highway or another floor to an apartment building, you may be waiting much longer than you had bargained for. Unfortunately, I don't think that situation is going to improve anytime soon. We have added almost no cement making capacity in the last 15 years. And while there may be limited additions, I think many parts of the country are still going to be experiencing shortages depending how intensive construction activity is at any one time. Well, people always want to know how long are contractors going to be suffering these price increases compared to bid prices. The Bureau of Labor Statistics does produce 5 indexes measuring what they say are bid prices. Specifically, they ask a group of contractors, how much would you charge to put up a particular building? They compare that answer to what the contractor said a month or a year ago. And so we get a year-over-year change in these hypothetical bid prices. Now, they're actually based on real projects, but since they're asking the contractor about the same project from an earlier era, and it wasn't necessarily the one that contractor worked on, it is somewhat hypothetical. But I think it's a good proxy for asking a producer, what did you charge last month for a gallon of gasoline or a number 368 widget? At any rate, what this graph shows is the year-over-year change in materials cost minus the year-over-year change in bid prices. This graph happens to show schools, but similar ones exist for office, warehouse, industrial, and healthcare buildings. And the red periods are periods when contractors were hemorrhaging profits because the year-over-year change in their costs exceeded the year-over-year change in the bid prices. That lasted for 19 months in the latest episode, and the peak was 3 times as great as ever before. But at the far right, you can see that that jagged line has now turned negative, gone below the 0 point, meaning that bid prices are rising faster than materials costs. So what's the takeaway here? First, a huge amount of variation from one period to another, and a lot of uncertainty, no predictability as to when this situation will reverse again. And I think the takeaway for owners should be not that, oh, I'm being gouged now because the contractor is not experiencing nearly as much in the way of materials cost increases as they're putting into their bids, but that contractors are very prudently leaving a margin for the likelihood that this situation will reverse and we could have spikes as big as we did a year ago. Here's what's been happening in terms of construction spending. The Census Bureau reports on the first business day of each month on what they call value put in place. They ask a large group of contractors to report month by month how much they spent on projects underway. And you may be familiar with figures from Dodge Data and Analytics or Construct Connect. They both privately collect information on the value of construction starts, and they put out a press release each month aggregating all the projects that started that month. The big difference is that their numbers put the full value of a project or of a contract into that press release, and then it disappears the next month. So their series is much more jagged, more like that red and black line I showed you a minute ago than this one, which, of course, the spending doesn't vary that much from month to month over the course of a project. They're both valid ways of looking at what's going on. The census numbers are what we call a coincident index. They go direct indicator. They go directly into calculating the gross domestic product. And the Dodge and Construct Connect numbers are leading indicators. But they all suffer at this point from a major defect, a drawback at least, that they're measuring the current dollars. So we don't know how much of this 9% increase in total construction spending put in place was actually new projects versus a price increase compared to what was going on before. At any rate, across the top line, you can see everything looks positive except single-family construction. As I mentioned, that's been declining. The spending on new construction has gone down for 6 months in a row, quite steeply on a year-over-year basis, down 10%. But multifamily construction still holding up, double-digit increases, and improvements really the star of the show, a 28% increase from year to year. As people who have been priced out of buying a new home decide to fix up the one that they're in instead. But better than residential is what's going on private and public non-residential construction. The rest of the slide shows those non-residential categories in descending order of November 2022 spending. And manufacturing construction has risen to the top of the league standings here, propelled by computer, electronic, and electric plants. The spending on those, specifically on the giant fabs, such as you're getting from Micron soon, may have broken ground, has tripled in the last year. But we're also seeing a big increase in starts for transportation equipment, auto manufacturing plants, and components, battery plants, and so forth. And I think we'll also see, as you've been experiencing around Albany, construction of plants to build materials or components for both offshore and onshore wind, for battery charging stations, of which we expect to see tens of thousands built, and many other kinds of manufacturing that is either reshoring, that is coming back to the U.S. after having been located abroad, or to serve new kinds of industries such as carbon capture. The second biggest category, also looking quite strong, commercial. Now, this is a term that gets used in a lot of different ways. For census, it means warehouse, retail, and farm construction. And you can see the warehouse figure up 18%, but I think that's kind of a last gasp. We know that Amazon has greatly cut back its new warehouse construction. Yes, you can get those beams that were supposedly all being bought up by Amazon a year and a half ago. Retail construction up 25%, but that's a bit deceptive. It's off a very low base. Retail was crushed by the pandemic, and even before by more of a switch to distribution direct to homes through warehouses. And furthermore, these categories, along with apartments, office, hotel construction, are all very vulnerable to the continuing increase in financing costs as the Federal Open Market Committee keeps raising short-term interest rate targets, and also the increasing construction costs. In order to cover those costs, owners are looking to raise rents, and instead they're running into resistance as the double-digit rent increases that we saw for apartments and other kinds of income-producing properties are now flattening out or even declining. So I do think that we're going to see a downturn in warehouse and retail construction later this year. Could be quite soon, and it could be quite severe. Now, highway and street construction up very strongly, and this doesn't even reflect money from the Infrastructure Investment and Jobs Act. In a minute, I'll show you some results from the AGC SAGE survey. And here's a sneak preview. I didn't mean to hit this yet. I'll go back to this slide. We released last week a survey of over 1,000 member companies on their experience in 2022 and their expectations for 2023. And I'm happy to say that we got 29 responses from New York-based contractors. So if you're among them, thank you very much for taking the time to do that. What I wanted to mention here is that hardly any contractors say that they had won projects under funding from the Infrastructure Investment and Jobs Act. Among the New York contractors, only 7% said that they had worked on new projects funded by that law, and 7% said they've won bids but have not yet started work. But I think in 2023, we're going to see a lot more of those projects finally awarded. It's taking a long time for the federal government to write regulations and to sort out some of the ambiguity and uncertainty in the law. But I do expect continuing growth this year and beyond in highway and street funding, but also other forms of infrastructure. So that would include the transportation segments, the sewage and water segments, and then broadband communications facilities, among others. Let me go down this list a little further, though. Power construction is a term that the Census Bureau has a unique definition for. It includes every form of electric power generation, transmission, local distribution, but also spending on oil and gas fields and pipelines. I don't think that oil and gas part is likely to grow this year, but the electric could turn around depending how quickly decisions are made about allowing siting of transmission lines or wind farms, and also how quickly those battery charging stations get built. Education construction, certainly important in New York at both the primary and secondary and the higher ed level, up very modestly and perhaps not at all in real terms, that is inflation adjusted terms. But I do think that the rise in house prices is going to be translating into higher property tax receipts that will help a lot of school districts. So I think primary, secondary, public school construction does have a bright outlook. Higher ed, though, many colleges, both the private ones scattered through New York State and the public ones, have seen a big loss of students since the pandemic and a lot of unbudgeted expenses. The demographics certainly are working in the wrong direction. Smaller graduating classes from high schools, fewer students coming in from abroad, and those were usually full pay students, and adults who formerly went back to college or maybe community college to get a new degree or certificate. Now they're able to get a job without doing that. And so enrollments are staying down, and therefore both the funding ability and the need for new dorms, classrooms, and other facilities is down. And I think higher ed spending is very much threatened. Higher ed construction spending. Office, this looks positive, but in fact, there are two jokers in this deck. All of these non-residential categories include renovations and even repurposing. And we've been seeing stories about office buildings in Manhattan being converted to lodging, either to hotels or to apartments. That's certainly a minor part of the market, but if you were to take out the massive amount of renovation and remodeling going on in the office sector, the new office construction would not be positive. The bigger thing, though, is that office includes data centers, and that market still seems to be very hot. So again, if you take that out, new office construction is headed way down, and I think will remain depressed unless workers do agree to come back to offices in much bigger numbers. Transportation covers a mix of modes, and certainly there are big plans from the MTA and from the Port Authority for airport continuing work, for transit, for rail. We'll see if the Gateway project ever gets full funding and gets going. But Amtrak has ambitious plans funded through the IIJA. So I do think the transportation spending across different modes has bright prospects. Now, healthcare, you can see that all three of the subcategories were up in the latest 12 months, but I don't think that hospital construction is going to be a strong market. More medical care is being delivered in standalone clinics, even remote care, and urgent care centers. So I think more funding will be going into medical buildings and special care facilities than hospitals. Well, let me show you what contractors think. This is a result that I always look to in our survey. We asked, do you expect the dollar value of projects to be higher or lower than the year before? Projects available to bid on. So we're asking contractors about the categories they're familiar with. And we take the difference between the percent who say higher minus the percent who say lower and call that the net reading. So here you see that nationally, the top categories were bridge, highway, transportation, water and sewer, and federal projects. That is for agencies like the General Services Administration, Department of Veterans Affairs, Army Corps of Engineers. All of those had very strong increases, a very high number of respondents thinking that the market would grow compared to the percentage who thought it would decline. And among the New York respondents, those were also very strongly positive, in fact, much more so than at the federal level, or at the national level, I should say. Leading in New York State, you had 75 percentage points more respondents saying that bridge highway would be a growth market. However, at the other end, we had only three categories that were negative nationally: private office and retail and lodging, all expected to shrink. But among the New York respondents, there was also a lot of pessimism about manufacturing construction, about warehouse construction, and about multifamily construction. Clearly, the market expectations are different at both the upper end, more optimism, and the lower end, more pessimism among New York contractors. We also ask about headcount, and here New York contractors are showing a lot of optimism in spite of their gloomy view on some of the categories. 83% of you think that you're going to be increasing your firm's headcount this year. Only 3% expect a decrease. Of course, you're realistic that it's going to be hard or harder. 73% of you say it will become harder or remain hard to hire, compared to just 3% who think it will become easier or remain easy to hire. My own view is that the economy is going to stay out of recession. Now, that's a minority view among economists, and I'll admit that I'm a perpetual optimist, but I think I have good reason for it this time around. First, that jobs report showed more than 200,000 jobs being added and unemployment falling to a 50-some-year low. So that's hardly a sign that we're in or on the cusp of a recession. The job openings number across the economy has come down somewhat, but at 10 million plus, it's still well above what it was before the pandemic. So employers, by and large, are still eager to hire people in spite of the stories we hear each week about layoffs in tech or financial firms or some retailers that have misjudged the market like Bed Bath & Beyond. In addition, individuals, consumers still have a lot of buying power. And with inflation cooling off, it's still high, but wages are about to start rising in real terms again. I think in the next couple of months, we'll be seeing that those average hourly earnings are going up faster than the consumer price index. I do think that for construction, we'll see a continuing steep decline in home building, and that will affect some related underground utilities and roads, demand for schools and retail. But by and large, I think non-residential construction is going to be positive this year. On my watch list, multifamily, warehouse, retail, office, lodging, because of those rising financing costs and construction costs. But that should be outweighed by an increase in manufacturing, infrastructure, power construction, and continuing strong growth in data center construction. The number one concern for most contractors is going to be finding workers. And this isn't just a this year problem. It's going to last for a long time. We continue to see declining population growth, not negative nationally, but certainly in New York State, population has been shrinking. And that means slower or less availability of people entering the workforce and less ability of construction to compete for workers. It also eventually means less demand for housing, schools, public safety buildings. In addition, we'll be seeing a shift in where goods get distributed. We just have the completion of the biggest multi-story distribution center in the Bronx. I think we'll see more of those in congested areas, but also more facilities to deliver goods by drone or robotics. Healthcare, I talked about how that's evolving, and energy markets also will continue to evolve. A big question mark, particularly for New York City and its suburbs, is what's going to happen to office construction and office utilization. And I'm afraid I don't have an answer for that one, except in the near term, it looks pretty bleak. Well, here's a map of how population changed from July of 2021 to July of 2022. Census Bureau put these figures out about 3 weeks ago, and they show that U.S. population grew just 0.4%. That was a bit of a rebound from the first pandemic year, but still well below where we were before the pandemic. And unfortunately, New York is at the bottom. 0.9% loss of population. But you have a lot of company throughout the Northeast. In fact, 18 states, a record number, lost population last year. And population growth has been holding up or even accelerating in the Southeast and particularly the Intermountain West. And I do think these patterns are likely to continue, although we have seen some rebound in international immigration, and that has helped moderate the loss of people moving from New York to other states. I'll leave it there, Brendan, and see if any questions have come in through the Q&A. But I invite anybody who wants to sign up for my Data Digest, my weekly one-page summary of economic news relevant to construction. Just email me at ken.simonson@agc.org. Be glad to send along the New York State and national results from the Construction Hiring and Business Outlook Survey, and also the latest edition of the Construction Inflation Alert. That's a 9-page document intended to inform owners, officials, and others about what contractors are experiencing with materials costs, supply chain, and labor availability issues. And certainly take a look at agc.org. We have lots of other resources that should be useful to you.
Excellent. Thank you, Ken. We appreciate your time today. I don't have any questions at this point in the Q&A. I don't know if anybody's typing as we speak. I don't see anything coming in. But again, I think if anybody has any specific questions, we are recording this as well for anybody that did miss it or wants to share it with other staff internally. We'll make sure we get that out to everyone. And any questions, you can certainly send them through us and or directly to Ken if you have any questions at that point. So again, I don't see anything additional coming in at this point. So I want to thank everybody for attending. Ken, I want to thank you for your time. And again, as Ken had mentioned, hopefully, I got one quick question. Sorry. Question is, what's driving the population changes?
There are several things that are affecting population change. First, as I mentioned, with respect to school and universities, we have a lower birth rate. So the cohorts of people graduating from high school keep getting smaller. More of our population is beyond childbirth age. And so I think we will continue to see more people at elevated ages, which means a higher death rate. Unfortunately, we've also seen an increase in the death rate among working age people from suicide, from opioid use, and also from, in the last 2 years, certainly from COVID and from other diseases that were either worsened or not treated as a result of COVID. That piece, I think, should get better, but the other things that have led to elevated death rates, unfortunately, are likely to hold down population growth. And then the third thing affecting population nationally is net immigration. And that nearly tripled from 2021 to 2022 back to more or less the level that it's been for before the pandemic, about an increase of 1 million people a year coming to this country compared to the number leaving. And that, frankly, is good news for construction, because the construction industry historically has relied much more than other sectors on foreign-born workers. But very unpredictable. Certainly, Congress and the administration seem to be far apart on what new rules to write, if any, for immigration. So we will continue to have these battles, these uncertainty over how many people to admit. AGC of America has been pushing along with an essential worker immigration coalition to allow more employment-based immigration, but don't see any sign yet that the administration will write rules to allow that, let alone Congress agreeing on change in law. Now, in terms of population change by state, taxes are one thing that seems to affect that choice. And New York is certainly losing people, particularly to Florida, somewhat to other low or no income tax states. And then climate or weather is also a factor. Particularly as you have more of an aged population and in a market in which work can be done remotely, I think these things are working to New York's disadvantage, certainly to the disadvantage of New York City and its immediate surroundings. It has helped somewhat in boosting population growth and construction demand in some of the Hudson Valley and outer band of counties around New York City. But the rest of the state does have the disadvantages of a lot of cold weather, a reputation for state being hard to do business in, high electric costs in some areas, and also high taxes.
Okay, I do have another question. Basically asking, what are you anticipating for construction escalation / inflation for 23-24?
Okay, people do want to pin me down, even though I do my best to wriggle out of that. Yeah, as I mentioned, the latest reading on that construction materials and service input index was up 10.1% from November of last year. I'm sorry, November of 2021 to November of 2022. And the trend has been fairly steeply down, not negative, but moderating from over 20% for 12 months ending this summer. And I think we will continue to see moderation. We've seen lumber prices get back to pre-pandemic levels. Diesel still very elevated, but has stabilized somewhat. It's come down a good deal from its peak. Gasoline back down to where it was a year ago or lower. So these things will help moderate that overall PPI for construction. On the other hand, I got a dear valued customer letter last week telling me that one of the major national gypsum firms is going to be raising its prices 8% on average on February 1st. I mentioned the difficulties getting concrete. Those prices going to be rising much more than they have in the past. So I would say I would expect materials cost increases this year somewhere in the 7 to 9% range, a good deal more than the consumer price index, but less than we had. And then on the labor side, obviously, to the extent that you have contracts already in place that don't expire this year, that will help hold down the overall increase in labor costs. But if you're negotiating a new contract, or you have non-union labor, or you're looking at office and managerial labor, those things may be going up more than 6% this year.
Okay, great. Those are the only two questions I have for this morning. Again, I want to thank you for your time, Ken, and again, I hope we can. Oh, I'm sorry. If you want to take another one, I just got another question here.
Okay.
It says, per the BLS JOLTS data, construction continues to have near 400,000 job openings, 388,000 in November of 22, with minimal net hires, less separation. Do you think these openings are mostly in residential? And at what level do you suspect? The low unemployment, increasing earnings, and openings seem to point to continued positive momentum, despite some other headwinds. I'm continually surprised by the high number of openings.
I think you have a ringer in here. This sounds like an economist question. JOLTS, of course, is the Job Openings and Labor Turnover Survey. And that's where I showed the slide of job openings in construction in November compared to previous years, rising to a record level for November. It was crossing the line for hires, which actually declined steeply from November of 2021 to November of last year. And so the implication is that the industry is going to continue to struggle to fill positions. And let's get back. There's the graph. And I do think that this is going to be part of the story for 2023. Now, we can't tell from the JOLTS data whether these openings or net hires are on the residential or non-residential side. It's very interesting that two other things in the JOLTS survey are number of layoffs and discharges and also number of quits. And layoffs and discharges has been running at record low levels, meaning contractors are busy and they're really trying to hang on to every worker they can. And then quits, interestingly, has been fairly modest in the last few months. So generally, when you have work companies desperate to hire people, and you get a lot more quits. And that's the one positive thing, I guess, from an employer standpoint. But I do think that we will see more people leaving residential construction and perhaps being picked up for some types of commercial construction. But obviously, you have a skill mismatch on some kinds of jobs. So I think the outlook is still for a large number of openings and struggle to fill positions, and therefore upward pressure on wages, benefits, working conditions, and also more attempts to reduce the number of workers needed or the skill level of the workers who are hired, get more things done in a factory or an off-site setting, and find ways to make workers more productive.
Great, thank you. I don't have any, well, here we go again. Never mind, they just said thank you. That was that was the only comment at that point. Okay. So I think that is it. I think we're all set. Again, as I said, we have this recorded. I will make sure we have a registration list. We'll make sure we get a copy of the recording itself and PowerPoint out to you, to every attendee who registered, just so you have a copy of that. Again, I want to thank you, Ken. I appreciate the comment at the beginning as well, to remind everybody about the AGC annual convention, which this year is out in Las Vegas in March, which you can kind of do both that with Con Expo, which I know there's a number of our members are heading out to that event. So hopefully we see everyone out there. It's a great event. Thank you again, Ken. We appreciate your time.
Bye-bye.
Have a great day.